planning out where your stop and where your objective is on a trade before you take it, and how this can create a lot of problems, how this can justify certain trades, and how you can end up justifying staying in a trade by adjusting your objective. Not a situation you really want to be in, because when you initially take a trade, this has a reason. It should be clearly thought through. I'm not saying that your objective needs to be a specific point and you are looking for a specific number of ticks. What I'm saying is the reason for taking a trade on has implications for where your stop's going to be and also where your target's going to be. If you don't take your stop, let's say, when it goes offside, you get yourself in a lot of problems, because then you're in a situation where you've got a minimal objective that may no longer actually be valid, but also you've got an increasingly large stop that then starts to make the risk reward or the value of your original trade seem particularly bad. So this is why I would always caution against getting in a trade and just thinking, well, I like that level, I'm going to sell it. You take a trade on like that, and what you end up with is a situation where you get in and you then no longer really know what to do if that goes right or if it goes wrong. Have you got in at the beginning of a much larger move? Or have you got, are you about to take a stop that is either unnecessary or being taken way too late? I'll try and give you an example of this. This was something that we were actually discussing in the classroom, in the career group. One of the guys had taken this trade on and was trying to stay in and stay in and stay in. Now, of course, on a sim, you can get away with that. In real life, it can end up costing you a huge amount, particularly once you start averaging into trades as well. So the trade we're looking at here initially starts off as a sell at 01.5s. You've got a high up here at 03.5. This is in gold, by the way, from last week. Sell at 01.5. It's the top of this range. Seems a reasonable place to sell. It's a level that's held a few times. It's held as support as well as resistance. You've got protection at 03.5 just above. So as a place to sell, not a bad place to be interested in taking the trade on. Now, what you're looking for on this trade is really important in determining where your stop's going to be and also where exactly you're going to try and exit this trade. And this is where objective becomes so important. If you just sell this, well, what's going to get you out in either direction? So you're short 01s. Now, if your objective is to sell 01s and you're looking for it to trade back through this range, break the trend and potentially break 80s, I think you would be quite valid in saying minimum stop would be above 03.5, but you could also make the argument that this range stretches up as far as here, up as far as 08s. So you can then have a little bit of a bigger stop. You're looking for that much more trade or direction in terms of you going from 01s, you've got a target of at least $20 in this. So a stop of around about 10 seems fine. Risk reward looks pretty good. But also what you don't want to do is on a trade that is likely to take a bit of time and deviate around a price, you don't want to be giving yourself a really, really tight stop on that. However, if you're only taking this trade as a reaction and a move back down, and you're just thinking, right, 01s, we're going to get reversal back down to here, down towards sort of 99s, and then maybe back down into this range somewhere. So on a shorter time frame, we've got up to 95s. This is where the little push up had just started from. So that was a push up to 98s. So you got 98s and then potentially 95 at the beginning of this move as your short-term targets. Now, if you're looking for those, this is a scalp type trade. This trade can become invalidated quite quickly. Equally, it can play out relatively quickly. So your time horizon on this trade is probably quite low. You also then don't want to be taking a large stop on this, because if you're starting to look for a much, much bigger stop, the further through 01 that this gets, it's clearly no longer reacting to 01. And if that's the trade you're playing, a reactionary sort of scalp, then it's no longer reactionary scalp if it trades through and then breaks the next level. So if you're selling the 01 and a halves, after we've seen this pullback from 98 and continuation, 01 and a half comes in around about here. If you're selling that, you want to see this come back down at least towards 98 would be your minimum target, and maybe even down as far as 95. That's your reaction. Off the level, back down. Now if you're taking that trade and the market gets above 03 and a half, so above these highs here, you've got to be looking at that and questioning whether this is actually going to react at all, or whether this is a push through 01 and a half, trade higher, and is now going to use that as a base for a continuation. So unfortunately, for a psychological point of view, taking a trade like this can often result in a very quick stop out that you get in, and as you can see here, this is on a 1 minute chart, you're stopped out of that within about a minute. It's frustrating because you sell it and you pretty much go straight offside, market moves up, hits your stop and you're out. Not ideal, but the alternative to that is you hold on. And you start then saying, well, I'm actually looking for something different. That this isn't the reaction trade now, this is a trade where we're looking for a bigger move. And that then starts to change your view of things. What ends up happening is we trade through 01 and a half, we trade back, we've left low volume, and this is also a good sign that you don't want to be holding on to this. We've moved up in a trendy type fashion. Volume moves higher, accumulates higher, moves higher, accumulates higher. You get these patches of low volume, I've talked about these many times. When you're starting to see that, this is a strong indication that we're not holding down. So you have the opportunity, if you're willing to give up on this trade quite quickly, to actually enter a long now and say to yourself, this has changed, something has changed in the way this market's trading. I can now get long and start going for a larger move, perhaps up to here, up towards these 08s. Now someone who, of course, is still looking for the move all the way down here is fine sitting through this. They've got this trend protection, they've got the 08s protection, they're happy to see it test the trend and come off. And this is where that, that stop and objective comes in. Where you get yourself into trouble is where you then start saying to yourself, okay, well, I didn't get out there, it's now trading above, I don't want to get out higher because originally I was only looking to take a 20 tick risk and now I'm onto a much, much larger one. What then happens from there is we progress higher. This move then gets up towards 05s, holds the volume above 01 and a halves and continues on 05s. We then start pushing up towards 06 and a half, 08s. We get up to here and we start to consolidate around 08s. So that's just up around this area here. This is where you need to be careful with your stop. What I mean by careful, I mean actually rigid with your stop is the better word here. You've got to look at your stop and you've got to say, okay, if you have tried to hold on to that, it's now a long way offside. You've got to have a point where you say, right, this isn't going to happen anymore. You might feel you've got a good trade and you might feel that you're a bit pot committed, as a poker term. So sort of sense that you've bet on this working if you're playing poker and you realise that actually someone's got a hand that's got you beaten and you're not going to beat them. What you don't want to be doing is then taking an excessive loss. Yes, you've already lost and that's not great, but it's better than doubling that loss to stay in. In terms of a stop from here, if we start getting up above 08, your next area to be looking for is 12.6. Get above 12.6, it's the high volume, we're out of this trend line. There's very, very little reason to want to stay short. And so for that reason, that's got to be your sort of absolute stop up there. We trade up, you get a reaction from there, which starts to justify keeping the stop. and that looks fine. You know, you could have got away with that. You could have got the reaction, the market comes off. But as soon as it's through there, if you don't stop out there, you've then got to once again move the stop. Where's the next area for a stop? Up above these highs, up above 1522. So what's now happened is you've gone from an original stop of maybe 04s from 01.5, so 25 ticks, to now looking at somewhere in the region of 200, 220 ticks. Huge, huge stop, all for not being willing to take your stop at the right time. Because once you get through one level, your stop then has to go above the next. This then is totally out of whack with objective as well. Objective originally is to get back down towards 99, 95 area. Just to get back there, you've got to get a 200 tick move. So that's going to be hard enough. But the only way you could justify selling here and having a stop above the top of range is if you're looking for the move down through these lows, down through 1465. Which some people may well be doing. This is how ranges develop, because larger time frame participants use this range as an area to sell in. Build a position in that area, but that position is built not to get the next 10, 15 ticks, it's to get the next 10, $15. That's what's very significant there. So there are people who will be selling it here and will be selling it all the way up with stops up above here. But if you've sold it down here and you're just trying to stay in, what you've now done is put yourself in a very difficult position, and also put yourself in a position where your payoff for this trade is probably going to be quite low. There's not that many people who are going to be selling this. I don't know where that went just then. Not many who are going to be able to sell that and stay in. Furthermore, if you do break those highs, you then run the risk of further jump with stops as the bigger participants come out. So you're putting yourself into a great deal of danger here. So this is why it's so important to be very clear on where your stops are. If you stop out, you get the chance to play this again. You stop out above 12, let's say you've just sold it from here, trades off above 12, you get out. Okay, not great. Not great in the sense that you've taken a loss, but if that's where your stop is, good, you want to be taking that. As soon as it comes back through 12, you know that that was an important level. It holds just above it at 13. Once it breaks back through, you then get the chance to sell again. Now with an even tighter stop above 12. Having seen it touch the top of range and start reversing back, this is now a situation where you could well be selling with a relatively tight stop at a genuine objective of at least down to 99, and if not, through this range. It could still be a valid scenario that we could still be sitting in. So the really important thing with any trade is match up your objective to your stop. And the objective, what I mean by that, is not exactly the number of ticks. The objective is, if this is a scalp type trade, if you're looking for a reaction, as soon as the market's through the point where you expect a reaction, it's clearly not reacting. So don't hang around in that trade and start trying to justify it as something that it's not. If you're looking for the larger trade, if you're looking for the more swing type trade, then it's important to be in. Because the key to a swing trade is to make sure that you get in on every one that works right as much as you get in on the ones that work wrong. The ones that go wrong, you're always in on because you get filled at the point you wanted to get filled. The ones that go right, you don't always get in on. That's where it's important if it's a swing trade to get in. That can justify a larger stop. But you have to have that objective that this is a larger move. You're perhaps looking for the entire range to be traded through rather than just a small trade. And that's what I wanted to sort of highlight today. So make sure you're really thinking through what you're trying to achieve with any trade. That helps you explain where your stop is, helps you look for your target as well. The other thing I would always say as well, have that stop in mind before you get in the trade. Don't get in and then start wondering where your stop's going to go. So if you do that, you end up in a lot of problems that if you get in and you get a scenario like this, so let's say you sold there, it jumps and jumps. If you hadn't thought about where your stop is, you're now in a situation where you're a long way offside and you're panicking and scrambling for that stop. You can often end up taking the stop at the worst point in time, or alternatively trying to justify increasing that stop higher and higher and higher. So plan it out beforehand. That way it reduces hesitation. That way also, when you go back, you can look at your trade a bit more objectively and say, well, that was where I wanted my stop. Did I adhere to it? Yes, therefore it's a good trade.